Markets are pricing in a future where artificial intelligence changes everything: productivity, profits, even the shape of entire industries. But every transformational technology begins with a moment of excess, and investors are starting to ask whether we are closer to that moment than the markets are willing to admit. This is Dynamics' Tom Dicker. If your prediction is that there's a 50-50 chance that the AI bubble bursts in 2026, what do you say to an investor who's worried about a flip-a-coin nature to that investment?
Well, I don't think anybody wants to flip a coin with their retirement. And certainly my view would be that as the year goes on, the risk will probably build and not recede as far as whether or not we're in an AI bubble and that it could burst. So I think you want to diversify your portfolio. You want to own some things that aren't in the Magnificent Seven. You want to own some things like real estate and staples. I think we know, importantly, that we can't completely get out of equities. So I think you just want to take some risk off where it makes sense.
Coming up, how you shield yourself from a financial Skynet ready to terminate your portfolio. But first, something for the kids. Markets go up and markets go down. But with dollar cost averaging, we buy more when it's low and less when it's high, automatically. Warren Buffett used to say, "I buy steak when it's on sale." The billionaire investor offered this great advice for anyone doing their grocery shopping, but it does apply for investing too. Dollar cost averaging means investing the same dollar amount at regular intervals, regardless as to what the market's doing, up or down. By doing this consistently, you naturally buy more shares when prices are low and fewer when the prices are high. So you smooth out the volatility, reduce the anxiety, and steadily grow your wealth. Suppose you commit to investing $500 every month into an exchange-traded fund. In month one, the ETF price is $50 per share, so your $500 buys you 10 shares. In month two, market panic leads others to sell. But you've got a plan. That ETF is now $25, and your $500 now buys you twice as many shares. Month three sees the ETF rebound to 40, netting another 12.5 shares. After 3 months, you've invested $1,500, acquiring 42.5 shares, and your average cost per share is only $35.29. That's less than if you had just bought all of it all at once. By sticking to a schedule rather than chasing market highs and lows, you neutralize emotional decisions that often derail investors. If you prefer profit over prediction, dollar cost averaging is a strong strategy for the disciplined investor. Artificial intelligence. The risk is not that AI fails, but that the markets are overpaying for how quickly it delivers. So I wanted to get Tom's insight and look back historically at examples of other euphorias that didn't end up the way we had hoped. Is the AI bubble going to burst?
It's about a coin toss right now. There are definitely some hallmarks of a bubble right now. We don't have everything we had in prior bubbles, like in 2000. We have some of the things that you'd expect to see, like a lot of market concentration, some really high valuations, a lot of invincibility where dips always get bought. One of the things we haven't seen yet is, say, an IPO of OpenAI or Anthropic, which is why I'm not willing to say it's right now. But certainly risk appetite is very high. Make no mistake, this is a bull market. This is definitely a market where bullish sentiment, it remains really strong despite the high valuations, despite tariffs, despite DeepSeek, despite really high capital spending by a lot of players in the market. We're seeing a lot of risk appetite right now.
Let's talk about the fact that, well, first of all, both you and I use artificial intelligence every day. We see long-term potential for it. But how do we separate the belief in the technology from the skepticism about the scale and the speed of the infrastructure spend that we've seen so far?
I'm not an AI skeptic. I'm an AI bull. I love AI. I use Gemini myself. I was a ChatGPT person for the longest time. Mixing up neat technology and a company that's going to earn a decent return on its investment, or a stock market that's too crowded in a certain theme, the ability of the economy and these companies to earn revenue on the investment that they're making. Like, these are two very separate things. And while the technology cycle, like the internet cycle, is very long and will play out over many years, and I would say is inevitable right now, the CapEx cycle, the semiconductor cycle, which is driving the stock market today, that is cyclical. And those cycles don't play out over decades. They play out over quarters. And we're many quarters into this cycle.
So then what are the markets missing when they price in AI as a near-term certainty rather than a long-term transitionary technology?
Well, I think it's a few things. So first of all, one of the things that they're missing is how it's being paid for. Some of the CapEx is being paid for by folks that can afford it. You look at Alphabet, you look at Microsoft, they generate a ton of capital in their business. Meta, Amazon, they generate a ton of capital in their business. But many of their customers don't generate a ton of capital and won't forever. So you've got a situation where the profits of the most profitable companies, the big pieces of the S&P 500, for instance, are being subsidized at the top of the chain by losses at the bottom of the chain, first of all. Secondly, in terms of how it's being paid for, you're seeing things like GPUs backing loans. I know you're a professional computer geek, so you know the value of a computer. Like, would you give a loan that was backed by a computer? Like, I don't think you would, especially not a 5-year loan, whether it's the fact that it's going to become obsolete because the person who made it is going to come out with a better one in 12 to 18 months. So it's going to become obsolete quickly, or because all your competitors who are seeing your 75% margin are saying, I need to create something that's just good enough. And so you're seeing a situation now where it's not just super normal profits. I would say it's hyper normal profits right now, because you have such a shortage taking place in so many of the different areas of the AI supply chain. That shortage is inevitably going to end. Whether it's housing in Toronto, whether it's oil in 2008, the shortage eventually led to a glut.
So the pendulum, as it sounds like you're saying, is swung too far one way. Investors often confuse enthusiasm with inevitability. What does the current level of euphoria, though, tell you about the fragile AI investment thesis?
That level of euphoria can go higher. Like, we can get more euphoric than we are, but it is pretty high. And a few things I look at to measure euphoria, and this is a really big picture measure of euphoria: how much of the economy is being spent on AI or technology CapEx. And it's over 7% now. It's about 7.2%. The peak of the tech bubble was 6.4%. Now, after the tech bubble, it never went to pre-tech bubble lows. So there is a secular move higher, but certainly from a cyclical perspective, we're at very high levels of tech investment. Then you look at the stock market itself, very high PE ratio. But if you look at things like the CAPE ratio, the cyclically adjusted PE ratio, we're basically at 1929 levels, extremely high cyclically adjusted PE ratios, like scary high levels. So that's a big factor. Then you look at market concentration, as I mentioned before, again, very, very high. Equity ownership as a percentage of household assets, basically at all-time highs right now. So you're seeing a very euphoric market right now.
What does the level of euphoria tell you ultimately about how fragile the investment thesis is? You sort of touched on this, the idea that you've got companies buying product from other companies that are then providing the product to the original companies in the first place. And there is almost like a snake eats its tail component to the way the big boys are playing right now.
I think that's a great analogy. And ultimately, in any market environment, the marginal buyer sets the price. We're in a situation where there is a lot of enthusiasm, which brings in a lot of capital. The first capital is very smart. The second capital is average. And the last bit is very aggressive. And we're at the part where the most aggressive capital, which may not be the smartest, is chasing returns very aggressively. They're also renting data center space or building data center space very aggressively. And if the marginal buyer sets the price, we're at the point now where risk taking is probably happening at a level that it will not justify long run returns. And then I think on top of that, if you look at who's spending all this money, yes, like the bulk of it is being spent by hyperscalers. A lot of those companies would look at this as an existential risk. Not spending right now, it would be seen as missing the next big platform. Microsoft has in its DNA, don't miss the next mobile, right? Meta has in its DNA, don't be like Microsoft and miss mobile. Google looks at its search business and says, well, AI could replace search. We have to be there. We have to invest. So all that says to me, the moats on these companies aren't quite as good. They all would likely prefer to spend money at a slower race, but there's a bit of a prisoner's dilemma situation taking place. As soon as there's a pause, there will be an epic correction in some of these stocks, I would expect.
So the risk is not technological, but valuation risk, driven by optimism, leverage, and assumptions about near-term returns. We've seen this movie a few times already, and the market leaders that define an era one day can still disappoint investors the next. You brought up something interesting earlier about the comparison to 2000, the dot-com crash. This feels a lot like it to me.
I think there are some differences and some similarities. So in the dot-com crash, a lot of people would say, well, it's not like that because so many of the stocks that were driving it at the time, driving that bubble, were junk. Whereas this time, it's really a quality-driven rally. You can't argue with me that NVIDIA is quality or Broadcom is a quality company. That is a given. Those are good companies. They have good technology. They make a product that their customers want and need right now. I think the question is, what do you pay for it, of course?
Cisco Systems, perfect example of what we're talking about here.
I think Cisco is a great analogy for what took place in the 2000s versus now. I think if you had a few ideas in 1999 or 2000 that you thought you knew were true. So item number one, I believe that the internet is going to be bigger over the next 20 years than it will be today.
It's not a fad.
Yeah, it's not a fad. I'm a believer in the internet. Okay, you ended up being right about that. And item number two, Cisco is essential to build out the internet. You cannot have data centers and telecommunications hubs and telecom equipment without interacting with Cisco in some way or some other. So therefore, it's essential for this build out. You would have been absolutely right about that. Look around you, like you're using Cisco equipment right now, whether you believe it or not. Item number three, if you took it one step further and you said, okay, therefore, Cisco must be a good stock. You'd have been dead wrong about that. It's taken 25 years for Cisco to hit its all-time high that it hit. Why is that? Did its margins get crushed? Well, the margins did get crushed a year later, but actually they kind of went back within a couple of years. It was just that the growth slowed and competition entered. And when growth expectations and a little bit of margin compression happen, and a stock has divorced from reality, it's divorced from what is normal, and you've kind of escaped gravity, the corrections aren't 10 or 20%. Cisco went down 90%. I'm not predicting that that's about to happen to NVIDIA or Broadcom or any of these other companies, but I just think that's the cautionary tale. And that's the analogy you need to have in your mind, is that the infrastructure is not where all the profit pools lie over the life of a technology and a technological inflection. You look back to 1840 and the build out of the railroads. Railroads are still around in Britain, but everyone who built them, the folks that funded it, they got wiped out.
Okay, so then let's look at the historical record to give us a sense as to what the future may hold. Historically, how quickly does competition compress margins once capacity is built and the capital floods in?
It happens faster than you think. When you get the most powerful force in capitalism, which is competition, come in, things happen really, really quickly. And the Cisco example is pretty instructive. Within about a year after the peak, Cisco was taking a massive $2 billion inventory write down. and the stock had corrected pretty dramatically. I don't know if that's going to be the thing that exactly happens with Nvidia and Broadcom, but I would expect that over the next couple of years, you will see a lot of competition come in. These 75% margins are a magnet for the smartest people in the world to solve a problem.
Okay, so then what I'd like to know is what the trigger could be. I've come to learn that something in the neighborhood of 80% of AI initiatives launched at the enterprise level fail. Is it going to be the companies that are adopting AI, discovering that the return on investment isn't what they were promised, and therefore pull back on AI-related spending, as the trigger that leads companies, whether it be NVIDIA or any of the others within the space, to have that kind of dot-com style correction?
I think predicting the event that causes the landslide is super difficult. And in fact, when most folks look back at what causes a bubble to collapse, it's really only obvious in hindsight. I think it's more likely not that the returns don't look good, but that capital dries up. Folks just start to call BS on the need for more and more capital for OpenAI or whichever capital hungry buyer of equipment that is out there. And when those things start to fail, and it might happen much further down the food chain than OpenAI, it might happen with somebody much smaller. But when the market starts to say, oh, geez, the emperor has no clothes here, these folks need X billion dollars, and if they can't get their X billion dollars, then that means this company doesn't get its revenue. That means that this company doesn't get its revenue, and all of a sudden, it can unwind very quickly. I would suggest it's much more likely to be a liquidity and solvency problem than it is, some broad view that this technology just isn't panning out.
History shows that great products do not guarantee great stock market returns. When capital spending peaks and competition intensifies, that brings us to the practical question for you and me. Where do we go when risk concentrates in one dominant theme? So while everyone's distracted with AI, where can we find quality at a reasonable price, which I know is your thing?
Yeah, that's our thing. And of course, I'm going to tell you, first and foremost, it's not in the Magnificent Seven, at least not every stock in the Magnificent Seven. There are some areas of the market that have been completely left for dead, whether it's REITs that have spent 4 years underperforming the stock market, whether it's staples that have been completely left for dead after having a very strong COVID. They're still suffering through that COVID hangover, whether it's even analog semiconductors or healthcare. There are lots of areas that aren't AI and aren't direct AI beneficiaries that have definitely got either attractive growth going forward that's not AI dependent, or really attractive valuations, or ideally both.
So as the United States calls for lower and lower interest rates, maybe the world follows, maybe it doesn't. Canada has a reputation for keeping its powder dry. What of real estate or other interest rate sensitive stocks?
So I think real estate has a particularly interesting setup right now, and interest rates definitely form part of the thesis. If you're a real estate investor, you're kind of on a ship where you're dealing with the tide and the wind, and interest rates are the tide and supply demand is the wind. And I think you've got at least two of the three. So supply, demand, and interest rates, at least two of those look pretty good right now. So rates definitely look like they're set to improve. Especially in the US, there's a mounting amount of pressure on Jay Powell to continue to lower interest rates. I was thinking about getting actually a free Powell t-shirt made for this. I hope that this is still funny by the time it goes to press. But certainly the interest rate situation is supportive for real estate investments. And on the supply demand side, for many areas, you've had 4 years, and I would say data centers are not part of this, but you've had 4 years where rates have gone up and supply has dropped off really dramatically, whether it's apartments, whether it's industrial. When the cost of capital goes up, supply comes down. And so we're seeing a setup where market rents, which have fallen for a couple years after being really strong through COVID and before COVID, are now starting to appreciate while you've had 4 years of not being AI related, therefore being ignored by the market. It's a really small sector right now, so it's been quite ignored. So those stocks are really, really cheap.
If your prediction is that there's a 50-50 chance that the AI bubble bursts in 2026, what do you say to an investor who's worried about a flip-a-coin nature to that investment?
Well, I don't think anybody wants to flip a coin with their retirement. And certainly my view would be that as the year goes on, the risk will probably build and not recede as far as whether or not we're in an AI bubble and that it could burst. So I think you want to diversify your portfolio. You want to own some things that aren't in the Magnificent Seven. You want to own some things like real estate and staples. I think we know importantly that we can't completely get out of equities. So I think you just want to take some risk off where it makes sense.
So Tom, for the purposes of disclosure, are you or any of your answers artificial intelligence?
All of them.
Tom, great having you with us.
Thank you.
Tom has helped us understand that believing in AI does not require believing current prices are justified. History reminds us that even market-defining companies can struggle once infrastructure spending peaks and the competition sets in. And protecting capital is often about looking where the crowd is not, assets that offer resilience rather than hype. If we have the discipline to separate technological progress from investment risk, we'll be on the money. I'm Michael Hainsworth. Thanks for joining us. Oh, and be sure to click the links, subscribe, click the bell, yada, 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 all that. It really does help.